The senator from Oregon is recognized for 10 minutes.
Mr. President, we're coming to the end of a long path of consideration of fundamental financial reforms. And a key piece of the discussion along that trail has been whether we're going to modify the way that securities operate, how high-risk investment pools operate, and how ordinary banking that takes deposits and makes loans operate, so that all three will do better in their role of aggregating capital and allocating capital. We have some fundamental challenges in our society, and one is that right now, inside of a bank holding company, you have both the high-risk investing and you have the standard process of taking deposits and making loans. Now, these two are both excellent systems, but they don't belong under the same roof, because when they're under the same roof, they create two problems. The first problem is the bank that is providing the loans has access to a discount window and insured deposits, and all of that is intended to make sure money gets to our small businesses and our families. But when they're under the same roof, you have the temptation of the resources being directed to high-risk investing rather than getting into the hands of our families and small businesses. Now, I can tell you in every corner of Oregon, and I think in every corner of every state, folks are finding it very hard to get loans. Lines of credit are being cut in half. Projects to expand and to hire additional employees are being thwarted because the local bank says, you know, we can't do any more lending because we've hit our limit on leverage and our capital is such and such. Well, you do not want the large banks that have both functions to be diverting their energy from and their resources from the lending, so important to Main Street, into the high-risk investing. So they need to be separate for that reason. And the second reason is that when the investing blows up, as it does periodically, then you have the situation where it blows up the lending, sends shock waves through the lending. It causes the lending to freeze. And when that happens, our whole economy suffers, Main Street suffers, our families suffer, and that's where we are right now. Now, let us take a look at the facts. We have a situation where over the past couple years here, we have seen Lehman Brothers that had high-risk trading losses of over $30 billion, and they went down. And Merrill Lynch with $20 billion of loss, saved by TARP. And Morgan Stanley, $10 billion, saved by TARP. And J.P. Morgan Chase, $25 billion from TARP. Goldman Sachs, $10 billion from TARP. Bank of America, over $45 billion in TARP funds. Proprietary trading blew up some of our biggest financial institutions and froze lending to our businesses on Main Street across this nation. We need to have a firm separation. We need to make sure that if you're buying fireworks for the 4th of July, you're not storing those in the living room. And by that I mean simply high-risk investing is the fireworks. And you don't store them in your living room where you're doing the lending so important to Main Street. So this is a Wall Street, Main Street battle. And my colleague Merkley-Levin from Michigan and I have been working on this for quite some time because we need to make our financial system work better for America. 2 days ago, we offered to have our amendment voted on, not with a 50-vote standard, but with 60 votes. And the leadership across the aisle thwarted that unanimous consent request. And so you may not have a vote on your bill. Not even at 60 votes? No, you may not. Not even with 2 of our Democratic senators off in their home states because they had primary elections? No, you may not. You may not debate this bill, this amendment, on the floor of the Senate. Now, quite frankly, that is the result of pressure from Wall Street saying that fundamental financial reform should not be discussed in this chamber. What is this chamber? Is this chamber a puppet to Wall Street? Or are we a serious gathering of men and women from across this nation whose responsibility is to build a better financial system? Now, another fundamental piece of this bill is to end the conflict in securities. Now, this is very simple. If you design securities and you sell them, you don't take out insurance on them because you think they might fail after you've sold them. That's the fundamental conflict of interest. That's like somebody who wires your house and you bring them to your house and you say, please do the wiring or fix the wiring, and they take out a fire policy on your house because they know they did such a bad job, they think your house is going to burn down. You would never hire that electrician. Or it's like going to your auto dealer, and the auto dealer says, hey, I'll sell you this car. And after they sell it to you, they take out a life insurance policy on you because, why? They didn't do the brakes right. It'd make you pretty nervous. You would not buy a car from an auto dealer who's taken out an insurance policy in your life. That is the simple issue addressed in the securities provision of this bill. Now, we are hearing word that the Republicans are going to go through a parliamentary maneuver, even though our amendment is now in order and pending, that they're going to go through a parliamentary maneuver to kill the debate on the pending Merkley-Levin amendment. Now, we hope that's not true. But we're hearing in not so many minutes, sometime this evening, there's going to be a process to kill the amendment that our amendment is attached to so that there will be no debate on this issue. I must say, I cannot believe the Senate of the United States of America is afraid to have a debate and a vote on fundamental financial reforms important to the integrity of our securities and important to Main Street getting loans. But that seems to be where we're headed. I hope I'm wrong. I hope that my colleagues from across the aisle will come out and say, no, we've reconsidered. We think that this body should debate serious issues. You might win, you might lose, but we should hold the debate. Now, we have asked the Republican leadership to sever the connection between our amendment and the Brownback Amendment, which are on different topics. One on fundamental financial structures, and one on automobiles and involvement in whether or not they are covered by the Consumer Financial Protection Bureau. We've said sever them, have each a separate debate, and they have told us no. They will not sever the connection and allow a debate on each topic. And that's why, if the primary amendment is withdrawn, ours will go down too, and the people of the United States will be deprived of having a government, a legislature that debates seriously the structure of reform. So, I will wrap up here. I know my colleague is going to expand on these remarks, and it's been a pleasure working with him. It's been a pleasure working with the banking staff. But before I conclude, I want to note that based on the conversations I've had in this body, if we were to have this vote, we would win tonight, based on the comments of folks who are saying they're either supporting it or strongly leaning towards supporting it. We would win. And that means that we would go to conference with a very strong position, as we should. And if this is withdrawn tonight, if we are not able to have this debate, we're not able to have this vote, I hope that the leadership on both sides of the aisle will say, even though we didn't debate it, we will take this strong position for financial reform to the conference. You know, the USAA, which is a group that serves our veterans, has comments about this bill. They say Senators Merkley and Levin recognize the value of insurance company investments, which already are subject to well-defined state insurance restrictions. In that vein, we urge you to support the amendment and include it in the Restoring American Financial Stability Act passed out of the United States Senate, May 13, 2010. A person in the Washington Post writes, probably the most important pending amendment comes from Senators Carl Levin and Jeff Merkley, Democrats from Michigan and Oregon, respectively. It would replace the vague language which gives discretion to regulators with a clear provision banning federally insured banks from such trading. If the banks want to turn themselves into casinos, they can, but if Merkley-Levin passes, they would do so without taxpayer support when their bets go sour. New York Times editorial says the Senate bill also imposes needless delays on the implementation of the Volcker Rule, which would bar banks from making risky market trades with their own accounts and from owning hedge funds and private equity funds. Senators Levin and Merkley, both Democrats, have an amendment to enact the Volcker Rule without undue delays or tinkering. The Community Bankers of America, the Independent Community Bankers of America, are asking for this to be passed to strengthen our financial system. The Campaign for America's Future, the former head of Citibank, who watched as the two sides of his bank collided in a spectacular disaster, is supporting this amendment. This amendment should be debated and voted on the floor of the U.S. Senate. To do otherwise does not fulfill our responsibilities the people of the United States of America. Thank you very much, Mr. President.